Welcome to this webinar on self-assessment income tax returns. My name is Alison Ensor and I'm a partner at Foreman's. We are a chartered accountancy practice specialising in helping the self-employed make the most of all their tax allowances whilst remaining compliant. The aim of the webinar is to give you an insight into what a self-assessment tax return actually is. Identify if you need to complete one and how you should go about that. How the tax is calculated, and when you should file that return by. We will look at what the penalties are for non-completion. I've also considered the government responses to the recent pandemic and looked at how they affect the reporting and calculating of the tax for the 2020-21 tax year. A self-assessment tax return is what it says it is. You self-assess what tax you need to pay each tax year by collating the information and presenting it to HMRC. Depending when and how you file, HMRC may calculate the tax for you or you calculate it yourself. However it is done, you are responsible for it being correct, paid and filed on time. HMRC will check the return to ensure it is correct, and with the increasing access to data on computers, it is easier than ever for errors to be identified by the tax inspector. So who needs to file a tax return? Well, the very good news is not everyone. You do need to file one if your tax affairs are complicated, and there are certain categories of individuals who must file. They are the self-employed, company directors, trustees, and anyone in receipt of foreign income. Our best advice is to consider filing a tax return if your income is higher than the personal tax allowance for the year and not already taxed through your employer's PAYE scheme. If you decide you do need to file a tax return, then you should tell HMRC as soon as possible. For example, when you start trading or are appointed a company director at Companies House. Remember, filing a tax return is your responsibility, not HMRC's. It is not an excuse to say, I did not know I needed to do one. If you do need to register, you can do so at www.gov.uk. You will need your unique tax reference, your national insurance number, and some information about why you believe you need to register. If you are registering because you are self-employed, then you must register with HMRC within a time limit. You must register by the 5th of October following the end of the tax year you became self-employed. So for the tax year 2020-21, you would need to register by the 5th of October 2021. HMRC will need your unique tax reference, your national insurance number, and some information about how you're going to trade and what you're going to do. Remember, it is your responsibility to ensure you register on time. There may be penalties for not registering. When you register the new business as self-employed, you should also consider registering for Class 2 national insurance, especially if you need qualifying years for your state pension. I have previously mentioned your unique tax reference, also referred to as your UTR. This is an individual tax reference which we all have. You may be aware of your national insurance number, but not everyone is aware that they also have a UTR. It will not automatically have been issued to you. You cannot file your tax return without one. If you have any personal correspondence from HMRC, it may be listed as a reference on that documentation. You are looking for a 10-digit number shown as 2 blocks of 5. If you don't have it, you will need to request it from HMRC. You cannot correspond with HMRC without it, and unfortunately HMRC will not release your UTR to your accountant, as it is personal information. If you're already completing tax returns, you should receive a notice to file from HMRC in the April following the end of the relevant tax year. So for 2020-21, those notices should have been sent out and received in April 21. If you're registering for the first time and HMRC agree you should file, you should receive a notice to file from HMRC as soon as you are registered. If you don't receive a notice, remember it's still your responsibility to file on time. It's not an excuse to say I didn't receive a notice. You complete the tax return or speak to HMRC if you don't think one is due. The main form to be completed is referred to as an SA 100, and there may be additional SA forms, so SA 105, 103 and 104, to complete dependent on what type of income you have. A new form is created for each tax year in order to account for changes in the tax regimes, so ensure that you complete the correct tax year form. So what income should be included on your tax return? The answer is all income you have received between the 6th of April and the 5th of April in a tax year should be included, whether you've already paid tax on it or had tax deducted at source from it. So, for example, your employment income as stated on your P60 received from your employer should be included on the SA 102, one of the additional forms to the SA 100, with the tax deducted also noted on that form. In simple terms, all the income is added together, the tax calculated, and any tax already paid deducted from that due. There are some specific exemptions to the inclusion, and if in doubt, ask your accountant or the person or organisation paying that money to you whether it should be included. Ultimately, you could always include in the any other information box of the SA 100. 2020-21 has been an unusual year in many ways, including the tax system. From a tax return point of view, we've seen a number of new sources of income for individuals and businesses in the form of coronavirus grants and payments from the government, some of which are taxable and some are not. From an individual's point of view, there are two main types which will form part of an individual's income, namely the furlough scheme and the Self-Employment Income Support Scheme, or SEIS. Both are taxable in the hands of the individual. Furlough payments should have been paid through the employer's payroll and therefore taxed at source. Any details will already be included in the P60 and therefore included in the tax return via the P60. SEIS, however, will not have been taxed at source and must be included on the tax return. An additional space has been created on the 2021 tax return specifically for this. The individual should add up what they have received in the tax year and include that on the return as part of their total income. There are also some expenses that can be included on your tax return to be deducted from your income before the tax is calculated. These are business expenses that have not already been reimbursed from the business. So, for example, business mileage not reimbursed could be claimed at the HMRC allowable rates of 45 pence per mile for the first 10,000 business miles and 25 pence per mile thereafter. Remember, these should be expenses not already paid to the individual by the business. Things such as professional subscriptions and training were paid for by the individual. One additional allowance may be of particular interest following the lockdowns, where someone works from home, work being income-generating work rather than just business administration. The HMRC allowance for out-of-pocket expenses is £6 per week. Alternatively, it can be calculated using bills, floor space, time used, etc., but that can be quite a difficult calculation. Due to the pandemic and the government instruction to work from home, HMRC have issued a concession allowing the £6 to be claimed even if you only partly worked at home during the tax year 2021. Once all the income, expenses and allowances have been identified on the tax return, then the tax calculation can begin to be carried out. In this simple example, we add together all of the income, gross salary from an employment of 28,000, self-employment of 15,000, a pension of 5,000 and rental income of 3,000 to give us a total income of 51,000. We then deduct some allowable expenses, being business mileage at £2,000. The total net income is therefore £49,000. The personal tax allowance for 2020-21 is 12,500. This is an allowance that every individual receives so that they can earn £12,500 without paying any tax. The taxable income, therefore, is £36,500. The taxable income of £36,500 is then taxed at the basic rate of tax at 20%, giving a tax charge of £7,300. In this particular example, the individual has already had tax deducted at source of £3,100 from their gross salary through their employer's PAYE scheme. The amount already paid to HMRC on behalf of the individual by the employer is then deducted from the amount due, giving a total of £4,200 to be paid to HMRC. Self-assessment tax returns are annual and relate historically to a period from the 6th of April to the 5th of April each year. The last completed tax year was the 2020-21 tax year, and we are currently in the 2021-22 tax year. The filing deadlines depend on how you file. If you want to file on paper, you can do so, but you must do it by the 31st of October following the end of the tax year. If you wish to file online, you must do so by the 31st of January following the end of the tax year. You can file earlier if you wish. So, for example, the 2020-21 tax year will need to be filed on paper by the 31st of October 2021 or online by the 31st of January 22. Any tax is due by the 31st of January following the end of the tax year, so the same as the online filing date. So for 2020-21, any tax due must be paid by the 31st of January 2022. The pandemic did cause issues with regard to the 2019-20 filing deadline of the 31st of January 21. The original paper filing deadline was the 31st of October 2020, and that still stands. The online filing deadline was the 31st of January 2021, and despite representations from all of the accountancy bodies asking for a delay to the filing date, HMRC insisted that it would not be postponed. However, on the 25th of January 2021, it was announced that there would be no late filing penalties imposed for returns filed by the 28th of February 21, effectively giving an additional month to get the returns filed. However, you should be aware that payments were still expected on the 31st of January 2021, and that deadline was not extended. Interest on late payments would therefore accrue from the 1st of February 2021. One area of confusion with regard to payments is payments on account. If an individual's tax bill in any tax year is more than £1,000, then they will be expected to make payments on account towards the following tax year. The payment on account is split into two equal payments, one due on the 31st of January in the actual tax year it relates to, and the second due on the 31st of July in the following tax year. For example, an individual has a tax liability for 2020-21 of £4,200. The payment should be made on the 31st of January 2022. Because the bill is greater than £1,000, the individual will also have to make a payment on account. The first payment on account for the 21-22 tax year is also due on the 31st of January 2022 and is for half of the previous year's tax, so £2,100. The total amount due to HMRC, therefore, on the 31st of January 2022 is made up of the 2021 tax due of $4,200 and a payment on account of for 21-22 of $2,100. The total due to be paid on the 31st of January 2022 is therefore £6,300. A second payment on account for the 21-22 tax year is due on the 31st of July 2022 for £2,100. The two payments on account will then be deducted from the amount of tax due for 21-22. If the taxpayer believes that their income tax bill for the next year will be less than the payments on account, then they can reduce those payments on account by asking HMRC to do so. However, they need to be aware that if this is then proved to be incorrect, there will be interest and potentially penalties for not paying the payments on account. If you file your tax return late, then there are penalties, even if there's no tax due. After midnight on the 31st of January, there is an immediate late filing penalty of £100. The penalties then increase. After 3 months, there is a daily penalty of £10 per day up to a maximum of £900, and 6 months late, 5% of the tax due or £300, whichever is the greater. These are cumulative penalties. There are also penalties for non-payment of tax, and interest may be charged. If you receive a late filing penalty and you believe you have a reasonable excuse, then you can appeal the penalty. You must have what HMRC regards as a reasonable excuse. I forgot to file is not a reasonable excuse, and appeal the penalty within 30 days of the notice of the penalty. HMRC have actually extended the 30-day appeal rule due to the current pandemic for up to 3 months if the delay is COVID-19 related. HMRC will normally expect to see proof of any reasonable excuse, which could include medical or hospital appointments, etc. There is an appeal form which should be completed and forwarded to HMRC. We would recommend also enclosing a letter, as there is little room for explanations on the form. HMRC have also announced that they may, in the circumstances, waive the daily penalties relating to any 2018-19 returns due to be filed online on the 31st of January 2020. If you did incur these penalties, you may wish to consider appealing them. We have discussed what to do if you are starting out with self-assessment and also if you're in the middle of doing self-assessments. But what should you do if you believe you no longer need to complete a return? Firstly, you need to ensure that you really do not need to complete that return. Remember, it is your responsibility to complete all returns. Get advice, whether that is from your accountant or from HMRC, by explaining your circumstances. Do not just ignore the request. If HMRC ask you to complete, you should do so. Otherwise, there will be penalties for non-filing, even if you do not have tax to pay. Once you are convinced that you are correct, that you do not need to file, you can write to HMRC or phone HMRC. Always get confirmation in writing so that you can prove that you really don't need to do a return and have agreed it with them. You can also deregister through your personal tax account. If you don't have a personal tax account, you can register for one of these through the .gov.uk website. The most important thing is ensure that you are correct, that you no longer need to complete that return, as it is your responsibility to do so. So you might ask, what do I do now? Well, the first thing is don't panic. You have time to sort this out. The 2020-21 registration deadline is the 5th of October 2021 if you're not yet registered for self-assessment, and the online filing is by the 31st of January 2022, so there's plenty of time. Don't, however, put it all to one side because that time will go quickly. You should have received most of the information you need for your tax return by now. So you need to decide if you need to do a self-assessment tax return. If you're not sure, seek advice. Ask your accountant. Register if you need to, if you decide that you need to do a return. Check everything through and ensure you've got everything, and then ask for a UTR. Complete the tax return, and most importantly, remember to file the tax return by the deadline date and pay all of the tax due. Thank you for listening to this webinar. I hope it's proved useful and answered some of your queries. If you do have any questions or you want to discuss your situation, please feel free to contact us at Foreman's and we will be more than happy to help. We look forward to hearing from you.